start the recording. So I am going to go ahead and start our presentation. Thank you, everybody, for joining. Welcome to our capital raising call. Not capital raising call, our Tuesday transformational call. I'll be all right. I don't even know where I am. I just want to make sure that I can see when people pop in because sometimes I can't see it. Can you give me a thumbs up? You see my screen? All right, so tonight we're going to talk about turning your retirement account into a wealth machine. Okay, so I'm going to go around it. So a disclaimer, investors, you must do your own due diligence before investing and understand the risks. Your projected returns, cash on cash, yields, yield return models are strictly the sponsor's best estimate. You may lose a part or all of your investment. I am not giving legal, financial, or tax advice. And then for this particular thing tonight, I am not a retirement fund expert, okay? So I want to make sure that I'm very clear that I am not an expert in this. I've helped a lot of folks invest with it. I have my own retirement plans that I invest with. So I am not the expert in it, but I've helped a lot of folks invest with it. And then again, on a syndication, your capital is locked up for 3 to 7 years, depending on the deal. So a little introduction to myself. My name is Trevor. I started passive investing in 2018, and I've been a limited partner in 20 syndications, and I've been a general partner in 20 syndications for a total of 40. I always love connecting with everybody. So I'm going to pop my contact info into the chat, and you can also scan it there. But again, oops, I messed up here. Sorry, hold on. I'd answered an email and I cut and paste something from the email. Give me a second here. Put my contact info in the chat. If you do call my cell phone, just text me and tell me who you are before you do, because if I don't have your number in my thing, sometimes I don't answer. So a little bit, I'm from Massive Capital, and massive dreams need massive actions. So again, tonight we're going to do a little bit of an intro. We're going to talk about syndications, how they work, because what I'm going to be talking to you tonight about is investing with your retirement funds into syndications. You can use your retirement funds for all types of things, not just investing in syndications, but that's where my knowledge really lies. We're going to talk about just what are investor returns, what should you expect, talk about investing with your retirement funds, why multifamily is still a good investment, and we do have a current opportunity that I will be discussing. So again, we all know this. This is why we're here on a real estate call, but the best time to plant a tree was 20 years ago. The second best time to plant a tree is today. So you need to try to take action. The sooner you take action, the sooner you'll be able to sit in the shade. So we'll talk briefly, what is a syndication? And a syndication is a group of investors who pool money or to buy to develop real estate. So mentioned before, I've been a passive investor in 20, sponsor in 20. Syndications are a way for investors to invest in larger properties that they couldn't do on their own. When I first started learning about apartment syndication, I never in a million years thought that I would be a partner in a $30 million apartment complex. It just blew my mind. And so I invested it. They actually had an investor event. And I was pretty impressed that, the first time I'd invested in something that large. So how syndications work, the general partners, sponsors, they're experienced real estate professionals. They organize the syndication. They secure the funding, and they implement the business plan. They're called the general partners. And then the limited partners, they help fund the project and they own a portion of the asset. So again, for those of you that know, when you're buying any real estate, funding is very important on how you do it, right? We've all read Rich Dad, Poor Dad. We've all learned about the power of leverage. So this is what makes real estate work really well, the fact that we can use bank debt to buy it. So I'm going to give an oversimplified version of a syndication. We're going to go buy a $10 million apartment. We're going to get a $7 million loan, which is a 70% loan to value. And we need to raise the other $3 million. Now, in reality, we're going to raise more than $3 million, but I like to keep my math simple. So we're going to go find some limited partners. You always hear in real estate about OPM, other people's money. To us that raise capital, these folks are the other people's money. And so we will go ahead and these folks will help us fund the syndication and they own a portion of the assets. So how this works is the general partners find a property to negotiate, they do everything, and then they will form an LLC, and then they will sell shares within that LLC through a syndication. Syndication is selling securities, so has different rules and different things, and then you bring the passive investors in to help fund the project. But here's the real magic of it. So again, the power of leverage to be able to buy an apartment complex, but the passive investors will be putting up about 30% of the capital, but they will actually own 70% of the entity that buys that particular property. And they will receive 70% of all the proceeds. So they receive everything as a pass-through. So if there's passive income, they receive the passive income. If there's depreciation, they receive the depreciation. If they're, and by the way, we'll talk about it later, but retirement funds don't get to participate in depreciation, sorry to say, but I want to mention it here and I'll mention it again later. But they own everything, and everything that happens, it gets passed through. So the limited partners also have limited liability. Their personal assets are covered beyond the initial investment. So again, on my warning, I mentioned that you may lose part or all of your investment, but you won't lose anything else. So if you're in the single family space and you go get a home and you personally sign for a mortgage or whatever, you're going to be on the hook no matter what happens. Here, what happens is the general partners, they're the ones that secure the loan and are responsible for it. And they're the ones that will be have the issues if for some reason they can't pay them. And again, with syndications, you can target in investments and it allows you to focus on specific projects. So again, you may not know a lot about multifamily, but you can invest with folks that know multifamily. You may not know much about assisted living, but you can invest with folks that know about assisted living. And it goes on, storage, retail, new build retail. There are a million ways that you can invest into commercial real estate. And again, the beautiful thing is returns are directly tied to the success of the project. So again, we make a dollar, 70 cents of that dollar will go to the passive investors, and 30 cents of that dollar, assuming it's a 70-30 split, will go to the partners. So again, there are two ways that we can do a syndication. We have two exemptions that are different. The first exemption, and we always start our deals with here so that non-accredited investors can invest. So again, a 506B is a relationship-based offering. So we must know each other. If you want a simple way to understand that, think of it as the buddy system. And there is no general solicitation, cannot advertise or publicly solicit. So if I had a 506B deal, I can't talk about it here because I don't always have an existing relationship with everyone. Plus these calls get posted on the internet. You can watch them on YouTube later. And so I couldn't talk about it. Also, just to make sure you understand, you're allowed 35 non-accredited investors, and you must verify that they're sophisticated. Well, there is no test to verify they're sophisticated, so you really have to have a mutual understanding with them that they understand at least the basics of those warnings I put at the beginning of what we're going to do. And again, it's only allowed 35. So what can happen is if it's a larger raise and there's a lot of interest in it, it could fill up to where there are no non-accredited investors allowed to invest. And again, reiterate, you must have a pre-existing relationship prior to or existing connection required. So before you got the deal, you have to have the relationship. Now, accredited investors can invest while it's a 506B. And in fact, I encourage it. I call it the easy button. If you're an accredited investor and you invest on 506B, you can just self-select that you're accredited. And you don't have to prove third-party verification. And again, I have to generally believe that this is the case. I suggest that nobody lies or cheats on this. This is very important because we are selling securities under exemptions. And then we'll normally switch our syndications to a 506C. So you'll say, well, why would you want to switch a syndication? So I can tell everybody. So I can generally solicit everything. I can mention it on this call. In fact, I'm going to mention the deal on this call. I can post it on my LinkedIn. I can post it on my Facebook. I was at a luncheon today for commercial real estate. I could talk to people at my table about it without fear that I'm violating any securities law. But only accredited investors can invest, and there are no exemptions. So again, accredited investor, income of 200,000 single, family 300, net worth of $1 million, and you must do verification. So you must have some sort of third party verification that verifies you are accredited. So another thing, we're talking about investing. You just got to make sure that you understand the basic returns, right? I'm talking to you today about using your funds from your retirement fund, but you need to understand what the returns and what the definitions are. My two favorite returns are IRR and equity multiple. Other folks don't like IRR. That's okay. It's their prerogative. My webinar tonight, so I can like what I like. But the reason I like IRR is it takes into factor the time value of money. And again, anybody a Wimpy fan, I'd rather have a hamburger today than maybe two tomorrow. I just want that little bit of surety you get the money. So the time value of money, it factors in the timing and magnitude of all cash flows. A dollar received sooner is worth more than a dollar received later. And it's not necessarily worth more because a dollar is worth a dollar, but it's worth more because you now got it back and you can reinvest it. So again, you can reinvest it and make sure that you get your money moving. Now, the next really important one, and a lot of folks talk about this, is the equity multiple, right? It's so, example, if I put in $100,000 into a deal, you told me it was going to double my money. That's a 2x double my money. It means my $100,000 turns into $200,000. So it's very important to understand that. But if you just look at equity multiple and you don't consider the timing, your actual return could be less. So I've created a very simple sample here. And what I've used is typically on a multifamily deal, you'll receive about 30% of your profits over the course of the investment. So you'll get some quarterly dividends from being able to invest. Sometimes you don't. So our new build retail, other things, it depends, right? Every deal is different. But I've sort of said if I could double your money in 3 years, that's a 26 to 30% IRR. So again, you can see this number is higher. So that's a good thing, right? Anytime your number is higher on your returns, it's a good thing. This is a little more typical of most syndications. It's a 5 years. And in 5 years, you could get about 15 to 19%. So again, 15% would mean very little cash flow, if any, during the period of the syndication. And 19% means you're going to get some more cash flow. But this is where it gets really interesting. If we can't sell in 5 years and we have to hold on to the property, or the whole plan was set up to be 7 years, and are only is still again doubling your money, your IRR is going to be about 10 to 12%. So again, still having a 10% IRR is not completely unacceptable. It's definitely you're growing your money more than you're going to grow it in most places. It's just you need to understand them. So my best real estate passive investment I ever had, and I wish I would get a few more of those, I got my money tripled in 20 months. That was a 56% IRR. I really enjoyed that deal. Invested right again with the sponsor. And again, the whole world changed. He sold it before the world imploded. And then he bought another property that I invested in, and the world kind of imploded. So while the property's doing good, I've actually been invested in it with zero cash flow for the last couple of years because they're banking their cash to be sure that they don't get overexposed. Now, other types of returns that are important to understand is cash on cash. And that's the annual pre-tax cash flow that flows into an investor related to the total invested. Cash on cash helps compare different deals weighted on the benefits of the cash distributions against the long-term growth. And again, the higher the cash on cash could be the higher the IRR, but not always, okay? Because the equity multiple on sale might not be as high. So it's a real combination of all of these factors. But as a passive investor, you want to be sure that you understand that you are going to be where are you going to get? What's going to happen? Now, this is another really important thing here, the preferred return. So this is an interesting thing. So remember, I've told you it's a 70-30 split, but a preferred return basically says it's a priority profit paid to investors, LPs, before the sponsor's GP earns their performance fees. The performance fees are that 30% I've talked about. So again, most of our deals use a baseline of 7% on their capital first, and it helps align the interest with the passive investors. So again, the 7% would show up on this cash on cash returns. So if you invest into a deal and it says you have a 7% preferred, I want to make sure I'm clear. That doesn't mean you're going to make 7%. What it means is me as a general partner, I don't make any money until you make 7%. So again, very important to understand the differences between them all. And again, it can get fairly complicated. And I had some folks, and I'm going to do a whole other thing about different capital stacks. They also thought there's a big difference between investor preferred returns and preferred equity. So again, I'm not going to get too deep in it, but it's something that you need to understand. And then ARR is just an annual return. So it's still very useful number. So again, if I doubled your money in 5 years, that would be a 20% ARR. So it basically just sort of says what's the end result and divides it by the number of years. So again, if you're interested in investing and you want to make sure you find the deals, please just connect with me. I love helping people learn about investing in commercial real estate. And again, all of the deals I do are through the Massive Masters program. And so it's a mastermind that we have. My original person I invested with 7.5 years ago was Sanjay. So I've known him my whole real estate investing career. And many of my deals are through the Massive Masters. And again, if you hang out with successful people, they will brainwash you into believing in yourself and thinking you could achieve anything. So again, super important, goes along with my statement at the beginning. If you don't find a way to make money while you sleep, you will work until you die. So again, I'm going to be very clear here. I am not a retirement account specialist. I have my own investments within my retirement fund. I help a lot of people place capital with their retirement funds. So again, super important for me to be sure I'm clear. I am not an expert, and I would refer you to an expert if you needed it. But a lot of people don't realize that you can use your retirement fund to invest in real estate syndications. So again, investing in real estate retirement funds can be a powerful strategy, but it only works when you follow the rules and you keep it strictly investment only. So again, there's lots of things. Self-directed is the usual vehicle, and it can count not you personally must own the property and pay every expense. So again, that's a little bit more if you were doing single families or other things. You've got to be able to look at it and do it that way. The funds will increase tax deferred or tax free. If you're smart like Jeremy and you've got a Roth account, they will come tax free. So again, I want to make sure I'm clear of the difference. First of all, I'm not an accountant, but what it means is it comes tax deferred. So I invest $100,000 with my retirement funds. I double it to $200,000. I do not owe any taxes on that gain until I remove the funds out of the retirement plan. So it grows tax deferred, not tax free. Now, again, if we're smart like Jeremy, and I'm going to give you an example later on, and you start investing with your Roth, the most powerful tool that there is to anybody involved in any type of investing is to invest through a Roth IRA. It will grow tax free, which is hugely powerful, very powerful. So again, what is a self-directed IRA? Self-directed IRA, SDIRA, is a retirement account. They have Roth, they have traditional, they have a SEP, they have an inherited IRA. So IRAs can be inherited, so you can structure it so that they'll pass to your heirs. And there's a simple. And it's where a custodian account allows the IRA to invest in any investment allowed by law. And again, I want to make sure I'm clear at this point that if you are an employed person, I have never seen it yet. I'd love to be corrected one day and somebody said I was able to do it. Your current employer will not allow you to withdraw your retirement funds and invest your retirement funds. And the reason is the game is rigged. Okay. They are all making money on you, whether you make money or not. I had my money in an account and I left it there. And I actually hired a financial planner, somebody smarter than me, to look at everything. And they said to me, oh, I said to them, they're telling me I'm getting 12% returns. By the time you took all the fees out, it was 7.8%. 7.8%, it's still okay. It was growing, still okay. And again, you have no control where you're going to put it. They have all of the control. They control everything. So again, you're going to want, now there are also a million ways that you can have plans. Okay, so again, I want to make sure I'm clear that tonight is not necessarily to break down all of the plans, just to make sure you understand you can use them. So you can have checkbook control IRA 401ks. You can have them. So the ones I have, and the majority, probably 70% of my investors, the custodian holds the money, and we're going to talk a lot about that. But there are other plans where you hold the money and you do the different things. And within these retirement plans, you can invest in real estate, but you can also invest in promissory notes, precious metals, private companies, stock, and more. In fact, you can invest in crypto with your retirement funds if you want to. So custodians, and again, I mentioned directed IRA because I use them a lot, but there are a lot of really good plans out there. They specialize in investors allowing to diversify their IRAs into real estate, private companies, hedge funds, note and deed and lending, precious metals, and other alternative investments. So again, the word is alternative investments. I have a lot of folks say, well, I think I can do it with my plan. And I'll say, ask the simple question, can I invest in alternative assets? Because real estate falls within the alternative assets. And again, 50% of the time they can, and 50% of the time they can't, because certain groups are structured to leave it within their funds or within their control. So again, how it works. You open a self-directed IRA with a custodian that allows alternative assets like private real estate syndications. This is huge. I made a mistake. I told somebody to go open an account, and they opened the account and they moved all of their money into a self-directed account. Please don't do that. I made that mistake for those folks. Open the account, put as much money in the account that you need to have into the account, and it will also set the process. Because what happens is, even if you're only earning 7.8% like I was, you're earning something. Now, because traditionally when it sits into a self-directed retirement fund, unless it's invested in some sort of mechanism, it just sits there. And we all know, especially with high inflation, idle cash loses value. So again, be very careful that you don't overfund your account, but don't underfund your account, because you're going to want to maybe pay fees and different things out of it. So again, I had somebody, they moved $100,000 to make an investment. Turned out there was a $10.50 fee and they couldn't fund the investment. And it literally, the guy had to move he couldn't even move something as small as $10.50. He couldn't make a personal payment to it. It was very frustrating. And again, you're going to do it. Then what you're going to do is, once you're there, you're going to choose a syndication. You're going to review the PPM, the operating agreement, and the subscription to documents. Again, I want to make sure I'm very clear. None of your custodians will vet your deal for you. They are purely the bank. They are only the bank. They are the ones that are moving funds. They are not giving you financial advice. Now, they will give you lots of advice, okay? If you get a good custodian, they will be putting on amazing webinars. They'll have very proactive websites. They've all got some really smart folks that are doing some amazing things that will be able to give you advice. But what they will not give you the advice on is it a good investment or not? So you need to make that decision. And again, you're going to move the money to cover the investment and any fees via the rollover transfer existing IRA from former employer plan. Instruct the custodian to invest the funds directly into the deal, and the ownership is held within the IRA's name. So again, when we do this, what happens is, at least the ones that I've been doing, some other ones are a little bit different if you have checkbook control and different things. But when you create your investment account will not be in your name. So for example, everybody wonders what the K is. My name is Keith, and my retirement fund is Keith Thompson, FOB, and it's got directed IRA and the number. Okay, I am not investing as me. I'm investing as it. And then the custodian, what happens is you check out the paperwork, you sign it. Then the custodian will say, would you like us to proceed on this investment? Now, they will check the documents to make sure they're correctly filled out. That is one of their services that they'll do offer. And sometimes I've had them make different alterations. And then what they will do is they will re-sign these documents on your behalf. And then they will re-sign the documents on your behalf. And then they will say, hey, Jeremy, do you want to fund the investment? And you have to digitally, electronically tell them, yes, I want you to fund the investment. And then what happens is the money comes from your retirement account into the syndication. Then as the syndication makes dividend payments or any payments, they go back into your retirement funds. You never want to break the loop of them going from your retirement account somehow to you or somehow to a third party person over to the syndication. They must stay within the confines of being in your retirement account. So they can never move out, because the second you move them out, it becomes a taxable event. Well, there's one thing I was going to tell a little funny story. So saying that you cannot touch your retirement funds. For those of you that remember the beautiful pandemic, did you know that the pandemic allowed you to take withdrawals out of your retirement fund? So I actually withdrew $100,000 out of my retirement fund. I had 3 years to pay it back with no penalty. And I invested in a syndication, got my money back, and put my $100,000 back into my retirement account. It was pretty cool. So again, you just want to make sure that you're playing by the rules. Now, if I didn't pay it back, I would have gotten a penalty for being able to do it. So again, you want to make sure that you follow this line of custodian so that you do not create a taxable event. Okay, some of the things that, and some of these talk a little bit more than syndications, but I want to make sure that I get all of these things in here. You cannot personally benefit from the work or use your property, or your spouses, your ancestrals, your linear descendants, and their spouses are restricted as disqualified people. So for example, if I am a general partner on a deal, I cannot invest with my retirement funds into my deal. I cannot be an active participant as well as a passive investor with my retirement funds. Now I can invest with my cash, but I cannot. So it's called a disqualified. Now, again, I'm not an accountant, I'm not a lawyer. You just want to make sure, because if you get caught, they will create a taxable event. So they'll say that $100,000 you put into the deal is now a taxable event. This could take a whole other webinar to be able to do, but syndications that use debt, you're going to perhaps incur UBIT or UDFI, and they will have to file a form. So if you are using debt, you may be responsible to pay some sort of penalties through your things because of the debt. I'm going to share a link at the end of here. They've got a really good webinar on it. I meant to have it pulled up, but I didn't, but I'll get it and I'll post it in the chat before we go. Again, very important. Keep the investment inside the tax advantaged account, which means the tax grows deferred, a traditional, or tax-free in a Roth. Okay. I know I'm yakking a lot here. So again, the account must stay self-contained. The IRA should pay any expenses. IRA income should receive the distribution. So again, If you have expenses, pay it all through the funds that are there. If you have income, make sure it goes back into that account. The custodian handles the administration, but not the investment advice. So due diligence is still your responsibility. So the fact that you're investing with retirement funds, cash, anything, all due diligence is your responsibility. These deals are not liquid, right? And a private sponsor, make sure that they qualify to be able to do it. And again, just making sure that you understand some of the things I said at the beginning, the fact that you got to understand that this is all, you're going to basically, it's going to be, your money is illiquid until your money comes out. So again, some practical, right? Make sure that you understand about UBIT, UDFI, because you may own taxes and you may need to file a form. Okay, now again, a lot of these things happen after you take your funds out. You're also going to get a Schedule K1, and even though the money's gone and never gone out, you're going to need the K1 to go over to your accountant. Keep cash inside it for tax and fees, and so you can pay them with outside money, and then recheck the leverage during the life of the deal to be sure that the UDF exposure can change as debt amortizes. So again, I'm not your accountant. I just want to make sure that these are all things that you need to watch for and understand. So again, there's a lot of potential benefits for you being able to use your self-directed funds to invest in real estate syndications for your real estate strategy. So I know I yacked a lot on the different topics. Anybody at this moment in time have any questions before we move on to some other ones? And again, I'm not a tax consultant, but I try really hard to offer really good advice. Does anybody, I didn't see anything popping up in the chat. You can feel free to unmute yourself, do what you want to do. Do you have a question, Jeremy?
Yeah, I have a question from this weekend, actually. Just I'll try to keep it general so it's
Yeah.
not so specific. Say you have one of a non-disqualified person, so not your parents, your spouse, or your children. Is that correct? For disqualified people?
Yes. Yeah. You want to make, so yeah.
Yeah. So say you have a business partner that wants to invest in, or invest is the right word. They want to sign up for a program, like a mastermind program, like this weekend, for instance. That you would then be brought on as a partner with them. Can you fund the sign up fee for the program by loaning money to the business partner that is registering for the program, because you're loaning money out to a business? And does it matter if you're affiliated like within the same entity, LLC, or for two different LLCs? Do you understand my question?
Yeah, I think I do. I don't, you can lend money through your retirement account, but I think the fact that you're a business partner could very much disqualify you. So again, I'm not an expert, so I don't want to guess.
Okay, got it.
Yeah. And I did put the link for directed IRA. I couldn't find my link to the but you go to their training thing and they've got a lot of things there. And again, I'm only using them. You can put your money anywhere you like. Again, you just be super careful. But so there's only one question I can't answer. Pretty sad, isn't it? I just don't want to give you the wrong answer, and I'd be just guessing. So yeah. Okay, perfect. All right. So this is one of the things that I like to talk about on commercial real estate investing, right? The power of compounding your money. So a lot of people think, oh, I'm going to go real estate investing. And we've talked about, right? We're going to turn $100,000 into $200,000. And we've talked how leverage helps you do that. But I want to talk about keeping your money moving and compounding. So assuming that you could invest 100, double it to 200. And I've taken taxes out of this scenario, and I've also assumed your money's always moving. two things that may not necessarily always happen, right? So again, if you could grow 100 to 200, then you take that original 100, the 100 you made, you grow it to 400, take the 400, you grow it to 8. And again, you got to remember here, we've still only started with $100,000 in cash, and we've let the cash compound to $3.2 million. Now, again, if you're investing with cash, there will be some taxes that will have to be paid. And now you've got the bonus depreciation and other things that you can offset it with and do different things. So again, there are lots of ways that you can defer paying taxes, right? Ken McElroy, if any of you guys follow him, he's Rich Dad Poor Dad's accountant. If you want to change your taxes, you got to change your faxes. So you got to make sure that you're doing what you can do. But this is where it's super powerful. So if you had this in a retirement fund, traditional, it would grow tax deferred. So you would be avoiding all the taxes until it was time to withdraw it. And if you were smart, like Jeremy's smart, and you took this $100,000 and converted it to a Roth and invested it,